Hello everyone and welcome to Zoo's interim results presentation for fiscal year 21. I'm Stuart Green, CEO. I'm joined by Phil Blundell, who's our CFO.
Hello everyone.
Just a little bit of housekeeping actually before we start. Firstly, this presentation is available in the download section of our investor relations section of the zoodigital.com website, so you can get hold of it there. And also, if you're listening to this live, there will be a Q&A session at the end. And if you'd like to contribute to that, you should find a question tab in the interface, and feel free at any point to type a question in there, and we'll try and get through as many of them as we can in the hour that we have available. Okay. So for the benefit of those who are new to the story, Zoo is a company that provides services in the entertainment industry. We provide those services to major players, producers of feature films and TV series. And what we do for them is help them to take their original programming and do everything that's necessary so that that content can be enjoyed by consumers all around the world through streaming video services. So just to elaborate on that a little bit and explain what's involved in that process, it may seem fairly niche, but in fact, there's a significant spend in the industry on these activities, and there are actually a wide range of different services that need to be fulfilled in order to do this kind of work. So from an original production, let's say it's an episodic TV series, to get that ready for worldwide release through streaming services, requires, first of all, that it's localized into different languages. And of course, you can do that by subtitling and overlaying text on the screen, and also by dubbing, which is where voices are replaced by speakers in the target language of the country into which the content is being delivered. Whether something is subtitled or dubbed is largely a function of what's the norm in the particular territory. So for example, in France, Italy, Germany, Spain, consumers generally expect content to be dubbed into their languages, whereas in other countries such as the UK, the US, the Scandi countries, audiences generally prefer things to be subtitled. In addition to the localization work, it's also necessary to adapt the materials in order to fulfill the specific technical requirements of the platform or platforms that the client requires their programs to be delivered to. And there are the whole range of services actually that are required in order to do this. First of all, the video and the audio and the subtitles and so on have to be in the right technical formats. So there is a degree of kind of conversion and conforming of media assets. In some cases, video will need to be adapted and brought up to the standards of today's streaming services. So for example, if it's content that's decades old, then it will have been produced to a relatively low resolution in comparison with the spatial resolution available in modern day streaming services. So there's work that needs to be done to adapt those things. Also, metadata needs to be prepared. The metadata is textual descriptions of the content, so a synopsis of each episode of a TV series, as well as lists of the cast and crew and characters and so on. And of course, that metadata also needs to be localized into the different target languages. And then artwork as well is something that you see in the interface of a streaming service, where you'll see still images from the program, and that all has to be prepared in the right resolutions and the right technical formats for the platform. So all these things together need to be undertaken, and there are a small number of vendors in the industry, Zoo is one of them, that can accommodate all of these services. And we and others like us are referred to as end-to-end vendors, because we act as a one-stop shop for our clients in doing all of this work in order to adapt the content for their platform. Now, all these things need to be done whether the content you're dealing with is brand new or whether it's existed for decades. But what tends to differ is the emphasis on the particular service lines. So for example, for new productions, generally there's not a lot of what we call digital packaging that needs to be done. But of course, the program needs to be localized into probably many different languages, both subtitled and dubbed. Whereas if you're working with back catalogue content, then there's usually a much greater proportion of the work involved in digital packaging type activities to get them in the right format for the platform. And often it's the case that historic content will already have been subtitled and dubbed into at least some languages, and therefore there is less of that kind of work to do. So that's just something to bear in mind as we come to talk about the performance in our first half, because that has had a bearing during this this pandemic period in the shift and the mix of the kind of projects that we've been working on. What sets Zoo apart in the industry is the proprietary software that we've created and we continue to enhance that gives us competitive advantage and which provides our clients with a whole range of different benefits. The software we've developed is deployed in the cloud. What that means is that the people who use it, which are our staff, the large freelance network of translators and voice actors that we work with, as well as our clients, all that we need to access these systems is a web browser on a laptop or an iPad or something like that. So it's very accessible and it's very scalable. And we have a number of different systems that deal with every part of the process of preparing content for release on streaming services. So I'll now very briefly cover the financial highlights, and then Phil in a moment will take us through these in a bit more detail. But just some key top line points to highlight are, first of all, we grew revenues by 15%. And just to put that in context, this is clearly at a time when most industries clearly have been affected negatively by the pandemic. And in particular, that's true of our industry, and many of our competitors have declined during this period. We've heard of declines of over 20%. And other competitors have been losing staff during this period, whereas we have been successfully growing the business. And that's as a result of our strategy, of the fact that we are able to deliver these services through technology that makes us very, very scalable and very adaptable, and that we're able to offer end-to-end services and therefore be able to shift our focus according to the needs of the clients as they have shifted over this period. During this first half, dubbing and digital packaging have been particularly strong, and we'll expand on that in a moment. We have seen a great deal of opportunity ahead, and indeed we've mentioned in our announcement today that we have the strongest pipeline of work and orders on hand that we have ever had. And the confidence in that has led us to make decisions to invest now in order to be able to capitalize on these growth opportunities in the second half and beyond. And as a consequence of that, you're seeing that there has been a reduction in both gross profit and EBITDA. And again, Phil will put more color to that in a moment. Finally, our cash balance is strong at the period end, up from 0.6 million in the comparative period, and Phil will give a bit more color to that too. Operationally, some key things to bring out are that during this period, we have delivered subtitling services to all of the major studios. That said, subtitling and indeed dubbing are services that are predominantly purchased in relation to new original content. And of course, this industry has had to call a halt to new content production, and that's still the case even now, and will still be the case for a few months to come yet. And as a consequence of that, the industry as a whole is now seeing much lower levels of demand for both subtitling and dubbing services. This is very much what we see as being a short-term negative consequence of the pandemic. And when things get to something like normality, we expect to see a full resumption of those demands for those services. We've added some significant new accounts in the period in terms of new clients, in particular 2 or 3 that we think will be very significant in future periods. And the overall number of clients has increased quite considerably over this period. And this has been primarily due to a large number of projects that we were asked to work on in the area of dubbing in the early stages of the first lockdown. And that was at a time when our competitor organizations were unable to actually provide continuity of service. So we were asked by some clients to actually start work on some new productions, as well as to complete some projects that had already been started by other vendors. Our cloud dubbing revenue grew substantially as a result on a year-on-year basis, because in the early part of this half, we were working through a large number of dubbing projects. But as I mentioned earlier, at the moment, the demand for dubbing within the industry is at much lower levels, because there has been very little by way of new content produced in the industry. We have one of our platforms, Zoo Studio, is what you might think of as a sort of specialist procurement system that we make available to our clients to enable them to place orders for all these service lines that are needed to adapt content for delivery through streaming services. And last year we announced that Zoo Studio had been adopted by a major OTT provider. And over this period, we have extended the platform, which has led to a much broader use of Zoo Studio, and therefore a greater volume of services have been managed through it by that same OTT provider. Digital packaging grew 33%, so a very significant growth there, but there is more to come. And in fact, based on the orders in hand that we have now and the pipeline that we see ahead of us, there will be significant further growth in digital packaging in our Q3. And finally, our client retention rate, which is one of the KPIs that we track, was very high at 98%. I'll spend a few minutes just reflecting on COVID and the effect that that's had on our business. Firstly, and as you'll sense already, we've been working with a much larger number of clients on dubbing during this period, because competitor organizations were unable to continue to operate. And that has provided an opportunity to showcase what we can do. There has been, and to some degree, there is still some skepticism in the industry that dubbing of the kind of standard and quality that's required by these major players can be done effectively anywhere other than in a sort of traditional purpose-built dubbing studio in territory. We absolutely contest that. We think that our cloud-based approach is able to produce work of at least equivalent quality to traditional studios, if not better in many cases. And this period has provided with an opportunity to prove that with a number of buyers. And as a result of that, they have been impressed with what we've been able to deliver to them. And our expectation is that once new content production resumes, that we'll be a significant beneficiary of work as a result. During this period, when obviously new titles are in short supply because resumption of production is problematic, we've seen our clients switch their focus to the back catalogue. So most of our large clients have very large back catalogues of entertainment content that they've accumulated over decades. And adapting that content for release on streaming services is something that has been ongoing for some time. But in this period, we've just seen a greater emphasis on that. And as a result, because of our end-to-end service proposition, we've been able to flex and adapt to that very quickly and very readily, and have been, and as a consequence of it, seen a significant uplift in work related to back catalogue. One of the interesting things that's happened amongst a number of our major competitors is that this idea of what they're referring to as remote dubbing has become something that they've started to promote. And this is interesting to us because prior to lockdown, these are, our biggest competitors were very much wedded to the idea that dubbing had to be done in dedicated dubbing studios in territory. And the idea that we were able to produce work of equivalent quality to them without owning and operating our own dubbing studios, was a ridiculous suggestion. Of course, what's happened during this period has been that those traditional vendors have been unable to operate because the restrictions placed upon them has meant they just can't work the way that they used to, and as a result, for a period of time, they were unable to process any projects More recently, they've resumed production, but with lower levels of throughput generally. But what they have done is provide their own response to this so-called remote dubbing capability. A number of them have adopted some generic third-party software. Others have invested a little bit in their own R&D to produce some tools that enable them to say that they have a business continuity solution in instances such as a global pandemic. For us, on the face of it, that looks like more competition. Actually, we think that we are a long way ahead of them. We've been investing in this technology for a number of years, and we have a very robust, well-proven, secure system for doing this on an end-to-end basis. So the effect of this actually we see as being a positive one, in that it is helping to educate the market that actually remote dubbing or cloud dubbing is an absolutely legitimate way in which to undertake this work, and that can only be helpful to support our messaging. As a result, we think that cloud-enabled services actually will accelerate across the industry, and of course, as a first mover in this digital transformation of media localization and digital packaging, will ensure that we are very well placed to capitalize on that. I'll just say a few words about the market, and I'd just like to share with you some recent research undertaken by Slater, which is a market commentator on the localization industry more broadly. What Slater have done here is to analyze the broader market for localization during 2019. So these figures are pre-pandemic. And what they've identified is that there is they believe that to be a roughly global spend on localization of over 24 billion, of which the media localization segment represents about 2.4 billion. It's the sixth largest segment in localization, according to Slater. It's the second fastest growing, both in terms of value and in percentage terms. And within that segment, Slater have confirmed a statistic that we obtained through other sources, that around 70% of the spend in the industry is on dubbing and the remaining 30% on subtitling. It's worth noting that in terms of the market that we focus on, media localization clearly is a big part of it, but we also provide these digital packaging services. And it's just worth noting that that is not included. Spend in that area is not included in this chart. Overall, our guesstimate is that there is sort of $3 billion spend globally on the kinds of services that we provide to the industry. I now just provide you quickly with an update on our strategic plan, which we track at each results period. So there are 5 pillars of that plan, the first of which is innovation and relates to the unique positioning that Zoo has as an innovator and with its own dedicated 35+ team of R&D specialists developing these proprietary technologies. During this period, we have focused most of our R&D efforts on two of our platforms, Zoo Studio and Zoo Dubs. In the case of Zoo Studio, we've extended its capability, and that has enabled us to deploy it much more widely and also more deeply within a major OTT service provider. In the case of Zoo Dubs, we've continued to enhance and develop that platform, and a couple of key things that we've added during the period have been support for multi-voice recording sessions. So we can now support multiple voice actors, either co-located or at separate locations, working together on the same program. And we've also taken a look at the video game industry, and in particular its requirements for dubbing, which have some similarities but also some differences when compared with dubbing for linear content. And we have implemented some capabilities to enable our platforms to be used for preparing soundtracks for video games. This is an area that we're currently market testing, and we think that there are opportunities for us in that area, which we will update you on in due course. And the final point on this slide is that we've secured some funding from Innovate UK, which is the UK government's innovation department. And this funding will support a collaborative research and development project with a partner focused on on speech technologies, and hopefully will lead to some advances which will provide further competitive advantages to our platforms. The second pillar in our strategic plan relates to scalability, and the scalability in our operation arises from the fact that the resources that we use for translation and for voice acting and dubbing direction is provided through a pool of freelancers. And these are individuals located all around the world who are specialists in their particular language. And we've grown that pool by around 26% to well over 8,000 individuals who collectively cover around 80 languages. The third pillar is collaboration, which is a key part of our strategy. We're a very capital light organization, unlike our competitors, which invest in building or acquiring physical studios across many locations. We can work much more efficiently. And part of our solution for doing this is through a program that we call our Zoo-enabled Dubbing Studios program, or ZEDS. And through this program, we form alliances with particular, highly reputable independent dubbing studios in different locations that give us a point of presence in those countries for particular instances where that is important in order to fulfill some particular client requirements. So we've continued to develop that program and bring new partners on board. And we've also kicked off 2 new collaborative projects with the University of Sheffield in the areas of machine learning, particularly for machine translation of media. Again, our hope will be that those will deliver innovations that will advance our products in future periods. The fourth pillar is around customers and the relationships we have with them, and it's our intention always to be on their list of preferred vendors. And as I mentioned already, a major OTT platform that we began working with last year has continued to work with us and has increased the number of their operating divisions that work with our Zoo Studio platform and with the services that we provide for media localization and digital packaging. We're also a Netflix preferred fulfillment partner. What that means is that we are one of a small number of companies that Netflix will direct its licensors to when it comes to having them prepare the content that Netflix licenses for distribution on the Netflix platform. So we started working with a number of new content owners during the period, and again, our expectation is that we'll be able to grow that business in future periods. And of course, a number of new streaming services, consumer streaming services, have been announced during this period and have launched in the US and North America. And I think it's reasonable to expect that at least some of those will extend their reach to international territories. And when they do that, we believe that we're very well placed to act as their go-to partner for providing these service lines to them. We added a fifth element to our strategic plan in this period, and it reflects the work that we have been focusing on to extend our capability and the breadth of services that we can provide in the area of dubbing. One thing that we've done here is to appoint Dave Concourse, who's an Emmy Award-winning re-recording mixer, who spent a good part of his career working with Disney and other major studios. We've appointed him as our head of sound, and he's now working with us to ensure that we have the right processes and procedures in place to deliver mixed soundtracks of the highest quality. And also he's helping inform our software product development efforts to make sure that we can automate and streamline as many of the aspects of that kind of work as possible to ensure that we can deliver projects efficiently and in a very scalable way. And we've also initiated a new function within the business that we refer to as our talent management function, the responsibility of which is to identify key advocates in key territories around the world, particularly in the area of dubbing, So these will be individuals who are well known and established and who have contacts, voice actors, dubbing directors, re-recording mixers, and others. And this will enable us to broaden and extend this community of professionals who work with us, particularly in the area of dubbing, enabling us to offer much greater scope and capacity to our clients going forward. So now I'd like to hand over to Phil, who will cover the financials.
Thank you, Stuart. So Stuart's taken you through our strategy. These key performance indicators are the measures that we use to judge whether we're making good progress. So the first one is that we aim to grow at double-digit annually, and you can see here that we've grown by 15% in the period. Stuart took you through those reasons, and I'll cover it again on a future slide. Our whole model is predicated on us making a profit, and in this particular period, although the EBITDA margin dropped from nearly 13 down to 8, actually, compared to our full year last year, it doubled from 4 to nearly 8, and we anticipate that margin will improve as we go through the rest of this year. Our third financial KPI is around reducing our OPEX as a percentage of revenue, and we achieved that this period with the drop from 38% down to 32%. That's obviously a function of the revenue growth, but also it is due to an absolute cost saving of 200,000 as we weren't allowed to travel in this period just completed. Our operational KPIs are around capacity and also quality, and you can see here that we've increased our freelancer base by 26%, and customers who we had in FY20, 98% of them gave us business in this period. So again, we're obviously delivering a quality service to our customers. Thank you, Stuart. Just a little bit more detail on our profit and loss account. So here you can see the 15% growth. Oops, lost you a second. Cost of sales for us is a combination of direct costs, which are costs from freelancers, etc., but also it is the cost of our production department. So these are the people who manage customer projects. They do the quality assurance. They find the translators and the freelancers, and we put their cost into cost of sales. And the big talking point here is the fact that in the half we invested an additional 1.1 million in internal staff compared to the same period last year, and that explains, more than explains, in fact, because without it, the gross profit would have gone up year on year. But because we've invested in the future, we've gone from 5.8 down to 5.1. Within that investment, the bulk of the investment has been in the digital packaging department. You can see the revenue's up 33% there, but that's just the beginning. You know, we've already highlighted in the actual RNS that Q3 orders are the largest we've ever had, and we have geared up the team to deliver those revenues in that half. The second biggest investment is in the dubbing department. We really feel that this is our year to get real traction across a number of customers, as Stuart has mentioned, and we have doubled our investment in people who support those dubbing projects. As I said already, our OPEX went down by 200,000. However, it's still worth noting that we increased our investment in R&D by over 40% in the period. So one of the key platforms, as Stuart mentioned, is that we're all about technology. We can see that the industry that we're in is embracing technology, and we want to remain ahead of our competition. The only last point I'd make is on the loss for the period compared to the profit in the same period last year. There's a 600K negative movement based on the dollar falling against the pound when we revalue the convertible loan notes. It's a non-cash item, but it obviously makes the optics not look that great. Next slide, please. So moving on to the balance sheet, it's a little bit complicated because of the convertible loan notes and obviously the impact of IFRS 16 and the right to use assets and liabilities. However, just to give you a couple of highlights, we invested 1.6 million in new equipment, primarily storage equipment, and the comms that allow us to take assets from Hollywood into our systems, localize them, test them, and then put them back onto those streaming platforms. And again, that investment is probably a 2-year investment that was pulled forward, primarily because of the orders we had and the capacity we needed to deliver those orders. So we won't be repeating that expenditure in the second half of the year. Trade receivables were up 12%, but from a quality point of view, they're much better. Those who listened to our presentation back in March, we highlighted that there were some older debtors sitting in there. Those have now been collected, and that has had a major impact on the cash position improving. So the trade receivables in there are all fairly current and will be collected in the next month or two. Current liabilities have gone up quite significantly here, and that's due to the accruals that we've had to put in place for the dubbing projects. There is a real time lag between suppliers giving us their invoices and us matching them to our revenues. And so there is quite a large cost to sales accrual sitting in current liabilities at the moment. However, when you match that with the receivables and the cash, there's a positive 2 million sitting there. And in addition to that, we have working facilities of 2.8 million that currently we are not utilizing any at this point in time. And I think that's probably all I'll say on the balance sheet. I'm sure there might be a few questions a bit later. Margins, you know, this is really the key driver of our future profitability. The highlights there of 41% down to 31% doesn't look great. However, we only achieved 31% in the whole of last year. And again, this is down to, first of all, that increase in people for delivering projects in the second half of the year, and also the mix. Dubbing was roughly 50% of localization in FY21. It was 10% in FY20, and dubbing has a much lower gross profit than subtitling or digital packaging. The digital packaging came in at 66%, same as last year. Software solutions, 96%, same as last year. So what that tells us is that there's really no pressure on our pricing or from our suppliers. It's just the mix and the fact that we're investing in the future. Thank you, Stuart. And then finally from me, just to sort of reiterate why we're an interesting company still very much at the beginning of our journey. You know, we are in a growth market. It's a growth market that's also expanding internationally, and that's the key service that we deliver. So we have a double bonus in terms of that. Our competitors are struggling. They don't have the technology. They don't have the remote recording that we have, and they have suffered. Stuart mentioned it earlier that anecdotally they've seen about a 20% drop in their revenues, whereas we've seen this obviously 15% increase. Over the last 6 months, the number of studios that have worked with us using our cloud technology, particularly in dubbing, has increased significantly, and the feedback we've had from all of them is very positive. And they're now starting to think about us for their originals when that resumes, probably in 2021. I think the other key point to make about us is that we are first mover. We have the best technology. We have the technology for the future of the industry, but also we have the right people as well to be able to deliver the services that our clients are looking for, and that's what differentiates us from the competition. Back to Stuart. Thank you.
Thanks very much, Phil. So wrapping up then with the outlook, The first thing to say is that our technology is becoming increasingly embedded into the operation of major studios. We already announced last year one major success with an OTT operator, and we see further expansion of that. This end-to-end solution that we provide, which is market leading, continues to be a major beneficiary of this shift that's taking place within the industry. Obviously, over this period, there's been a move away from new productions whilst they've been halted into back catalogue. The nature of our proposition means that it's very easy for us to flex and to be agile and to respond to the needs of the client, which we've done very ably. The scope of the services that we're delivering to our major clients is expanding. So we're seeing within the industry an increasing trend for buyers to favor working with vendors like us that can offer an end-to-end service that makes things much simpler from their perspective. And we think that that will continue. And again, we are well placed to capitalize on that. COVID-19 has been an accelerator of change, of this digital transformation within our sector. So whilst we have benefited in the short term, there is actually a fundamental change that is taking place that will mean we will be beneficiaries in the medium to long term too. Our trading in the first few weeks of our third quarter has been strong. Indeed, as we said in our statements, we're seeing the strongest period of order book and growth in our history, and our expectation is that half on half we will deliver 20%, at least 20% growth. And as a result of which, you may have seen that the analysts that follow us have increased their forecasts for this year and beyond, and we are confident of achieving that increased market consensus for the full year. So that concludes the presentation. And what I suggest we do now is go to Q&A. So whilst we've been speaking, we've had quite a few questions that have come in, and we'll try and get through as many of these as we can in the time available, and we'll take them in the order in which they were asked. So first question comes from, first three questions actually come from Juice Van Wyck, who firstly asked, how many of the additional 65 personnel compared with the same period last year are related to dubbing? So what I can say here is that the dubbing has been an area where we've invested, and we've certainly taken on additional people there. The greatest proportion of that 65 have actually been in relation to the digital packaging services that we have been ramping up. Phil, I don't know whether you actually, off the top of your head, happen to know the breakdown.
Well, fortunately, I saw these questions while you were tapping away there, so I was able to. So the dubbing department has 10 extra heads in it.
Okay, great.
And the digital packaging is 35. Great,
thank you. And then the next question from Juice is, how much of your $9.9 million localization revenue for the period relates to dubbing?
I actually said that in the half.
Great. Okay. And then just final question. Do you expect digital packaging demand to fall away once new content production will pick up again? If yes, to what level? Okay, that's a good question. So, so recall that I said the reason that digital packaging is so particularly high at the moment is because all of the focus of our clients has been in the recent period on back catalogue. And back catalogue has a much greater requirement for digital packaging. So I think once the situation normalizes and studios are able to get back into production, and we're then working on what's more like the norm for us, which is a mix of some content is new, other content is back catalogue. I think once that happens, there will be, we might expect that the overall digital packaging contribution will fall in overall terms proportionally, but that said, we're obviously seeing accelerated expansion of our clients to move content over to the streaming services. So we can't see that far out at the moment to know whether our clients will maintain the pace at which they are repurposing back catalogue content. So I think it's a little too soon to say for certain on that. Okay, next question comes from David Bolton, which is that Zoo is seemingly operating in a growth area and revenue is increasing, but profit is severely lacking. When can we see some better returns, as expansion without returns is unsatisfactory? Are charges enough? Phil, would you like to take that one?
Yes, okay. I think the key point in your question, David, is growth. We are the smallest player in our market. We are punching above our weight, and we are trying to take market share from our competitors. That means we have to invest, and we're investing in two ways. The first one is in production staff to be able to deliver higher margins, and hopefully you'll be happy with what you see in the second half of the year. But the second one is we are still investing, relatively to our size, high amounts in R&D. So yes, 1.3 million of EBITDA is on the low end, but we explain why that could have been higher, but it isn't. The operating loss is after depreciation and amortization, and that's where the R&D spend is coming back out again. So as long as we're investing in R&D, we're not going to make super profits. That's just the case. And until we get to 100 or even 200 million of revenue, I think we will want to continue to invest and not push the bottom line. So it's coming, but we're still investing.
Thanks, Phil. Hope that answers your question, David. The next question comes from Nick Yates. What has been the percentage growth in the past 12 months of your continuing operations? And the follow-on question is, what percentage growth do you anticipate for such operations over the next 12 months? Well, what I would say about that is all our operations are continuing ones. I don't think we have any sort of discontinued operations. What's changed in this period is just been the mix of the kind of services that clients have placed orders for as a result of the pandemic and the fact that clearly new productions are on hold, and therefore we're not seeing new original content. Phil, have you got any other interpretation of that question that you would like to?
Yeah, so obviously in the published numbers, we only grew 3% last year. That was partly because the DVD work was quite significant in the previous year. This year, if you look at the analysts, we're looking at 24% growth. And we feel now that the DVD is a very small percentage of our revenues, as are the software solutions. We should be getting that sort of double-digit growth that I talked about in the KPIs on an annual basis going forward. And as a rule of thumb, 20% would be a nice internal target to have.
Great, thanks. Next question from Chris Carter. Do you use artificial intelligence in any of your work? The answer to that is that we do use some third-party services that provide sort of machine learning capabilities in certain areas. So an example of that would be for automated transcription. So if we have soundtracks that are relatively clean, that's to say there's not a lot of background sounds, music effects and such things, then there is third-party automated software that will basically transcribe speech to a fairly good level. It always needs to be inspected by humans and corrected, but that works reasonably well. And there are a couple of other areas where we do similar things. But in the over the longer term, what we're doing is actually investing in our own R&D projects, particularly in the area of machine learning, in order to provide us with competitive advantages in a number of different areas. And these include in relation to speech, particularly in providing automated feedback to voice actors to help guide them and support them, and provide an environment within which they can do their work more quickly and efficiently. Also in machine translation. Machine translation is an area of what you would more broadly perhaps categorize as AI. And the bulk of work that's been done on machine translation, and indeed its application in the industry, is primarily for literal translation of text. So think, translating manuals and brochures and websites and such things. What the current state-of-the-art in machine translation does not deal with very well at all is speech, is the spoken word, which is very nuanced. It's idiomatic. It contains cultural references and all sorts of things that means that a literal translation often is completely wrong for this kind of application. So one of the areas that we're actually have just started researching is in looking at applying machine translation type approaches to dialogue, and we have some innovative ideas about things that we think that we can do that could yield some benefits to our localization process for this kind of content. Next question comes from Patrick Leach, which is, how is Zoo Studio monetized? So recall that Zoo Studio is our procurement platform that we embed within our client organizations, through which they place orders with us for all of these services. And the way that we monetize that is is not by charging a license fee, but rather by having a different kind of relationship with our client that will essentially put us in a strong position to be able to secure ongoing levels of business with that client. So we, for us, Zoo Studio is a key part of our strategy. It's designed to help our clients to be very efficient and very accurate in the work that they do, and to be able to do that kind of work on a much lower headcount than they would otherwise be able to do. But as a result of them using that platform, we become beneficiaries of the orders that are placed, and that's the rationale for us in developing and continuing to enhance and support that platform. Thanks, Patrick. The next question comes from Charles McDonald, which is, why have trade payables increased much faster than trade receivables? Phil?
Right, two reasons. The first one is that the trade receivables at the end of March were very high, and we highlighted that, and therefore now that they're more normalized, the growth is not that high. On the trade payables side, the dubbing work, as I mentioned in my commentary before, there's a lot of cost to sales accruals that need to be put in place, and that's why the trade payables have gone up significantly compared to last year, because there was really no dubbing in there at all last year. Hopefully that answers that question.
That's great. Thanks, Phil. I think the next one is probably one for you as well, Phil. It comes from Christopher Stockwell. When new productions return and the industry is back to normal levels, what do you foresee as Zoo's sales mix between localization and digital packaging as categorized by your segmental reporting, for example, by 2022?
Good question. I think we know, as we're saying, we think that digital packaging will hold up. We're not expecting a major shift, but what we do expect is that the localization revenues will grow quite significantly. So it's probably the case that when we get to this year end, that digital packaging will be, let me just see if I can see that. It's going to be sort of 20 million. And so the digital packaging will be 3/4 of that figure, whereas in a more normal situation it will be about less than half, I think, is probably where we're heading once the subtitling and the dubbing pick up again.
Great, thanks, Phil. Next, another question from Nick Yates, which is, you have a roadmap to 100 million in sales, said to be a medium-term ambition. What time period are we talking about, and what net profit do you anticipate? So just for the benefit of others who may not be familiar with this, we ran a capital markets day back in September, and in that we provided a roadmap to achieving $100 million of sales, from our kind of current position of roundly 30 million. And our intention here was to really make it clear that that is an eminently achievable target. as a sort of a mid-term target. And as a point of reference, the biggest competitors that we have in our industry are achieving sales, and these are companies obviously that have been around for decades and providing these services for a long time, very traditional bricks and mortar businesses, but providing sales of these services that we deliver of around $200 million a year. So we see no reason why over a period of time we can't become one of the biggest, if not the biggest player in our sector by virtue of the competitive advantage that we have. So that's just a little bit of backdrop. So the question the question from Nick is, well, how long is it going to take you to do that, and what will profits look like when you get there? So on the first part I can answer, which is, when I say I can answer it, I mean I can give you an answer, which is that obviously if I were to put a date on it, it would become a forecast, and we're not permitted to do that. So it's something that we're very realistically working towards over the course of the next few years. As to what net profit looks like when we get to that point, that is probably something that Phil may be able to give us a steer on.
Yes, it depends what you mean by net profit, of course, but let's say that's operating profit after amortization and depreciation. We would definitely expect with that sort of revenue number for it to be a double-digit percentage.
Great, thanks a lot. Next question comes from Michael Crockett. Hi, Michael. Long time no see. You said that you're expecting a strong Q3 from digital packaging. Do you anticipate that this strength will continue into Q4 and beyond? So we are, our comment in the statement is on reflection of the orders in hand that we have right now, and those are for deliveries in Q3 and moving into the early part of Q4. So at the moment, we don't have commitments where we could project how those orders will continue into Q4. And indeed for our, so for internal budgeting purposes, we're assuming that things will return to some kind of normality in a Q4. But it is quite, potentially possible that the sort of streams of work that we're seeing at the moment will actually continue longer. Phil, I don't know whether you want to expand on that at all.
No, I think that was a very good answer. We've only suggested in the discussions with our brokers and our analysts that you need to work off orders on hand rather than what we might get. So we've taken a very prudent view on our forecasting.
Yeah. Thanks. Next one comes from Patrick Leach. What do the unallocated items in cost of sales relate to? Phil, this is a segmental reporting note in the results.
So as I said earlier, we allocate our production staff to projects. So they all fill in timesheets and they allocate their time to projects, which those projects feed into that segmental reporting by service line. However, they obviously have holidays, they have sickness, they have admin tasks, which goes into other buckets, and that bucket is classified as the unallocated costs of sale. So it's a people cost that's not directly attributable to a project.
Great, thanks for that. Another one from Nick. The question is, what is the advertising revenue? And for the benefit of everyone in the audience, one of the service lines we offer is for a very fast turnaround captioning service for producing for commercials. And we work with quite a few advertising agencies who are producing commercials, and they'll come to us, usually with very little time to spare, to create captions on those titles before they're played out on usually UK television. It's not a figure that we've ever published in the past, and I don't think we'll probably give a figure for that. Phil?
No, but it is quite small. It's definitely less than 5%. We do show it in the subtitling category, which therefore feeds into localization. But currently it's in the roundings.
Okay, thanks. A question from Alex Stephen Haynes. What are the methods that will be deployed to improve margins in the short to medium term? Probably one for you, Phil.
I get all the easy questions now. I think it's more of the same, really. It's improving our technology to make our production staff more efficient. It's using more freelancers and less studios on the dubbing side, because we make a greater margin where we use a freelancer than using a studio to support us. And again, more automation around the digital packaging. So that's really the key areas. I suppose the other area that we haven't talked about at all, and this is probably one for the final results, is that we do have plans to go more international in terms of our headcount and our locations. And we would expect that if we were to start doing projects from certain other locations other than LA or the UK, we would improve our margins because it would be a lower cost of sale.
Okay, thanks. Next question is from, and I hope I'm pronouncing this correctly, Leela Lakmane. So 2 questions here. Firstly, are you selling Zoo solutions only as software for dubbing studios if they are still not considered as partner? So the answer to that is essentially we invest R&D resources in creating software that will deliver Zoo with a competitive advantage in the services that we deliver, because we are a service business. We generate revenues for providing these services to our clients. So so clearly making our software, which gives us competitive advantage, available for anyone to license is at odds with our business model. We do make our systems available to partners, and for example, those participants in our Zoo-enabled dubbing studio program do use our systems. We train them to use our systems on projects. So these are, the result of kind of close collaborative working arrangements and relationships. And the second part of Leela's question is, which countries, including emerging markets, do you consider as priority target? And the answer to that is, at the moment, we are the bulk of our efforts around dubbing is focused on the kind of mainstream markets, but also on those markets where our customers and streaming services more generally have a big push to get content out. So so at the moment, South Asia, India in particular, is a big growth area for our clients and therefore for us too. Southeast Asia more broadly is a big growth area. The Middle East and Arabic related services are important right now. Moving forward, we see ahead that Africa will become increasingly important in the periods ahead, but the ones I mentioned are the ones that are significant right now. Okay, next question, another one from Alex Stephen Haynes. What are the plans for improving the margins for dubbing work? Perhaps I'll start that, and then Phil, you may like to add to it. So the just for clarity, the way in which we provide dubbing services is through enablement in our technology platforms. And what our platforms provide for is a way to be able to do dubbing in a distributed way. So unlike the sort of traditional approach where all the voice actors and other talent converge in a single location to produce a single language edition of a program, we allow voice actors, dubbing directors, and others at different locations to be able to collaborate efficiently in order to work on the same project and contribute towards the same soundtrack. And that obviously then has, there are lots of benefits that come from that. It's incredibly scalable, it's very capital efficient, we don't need to own and operate our own studios, we can be very agile, voice actors often will have their own facilities where they can create high quality voice recordings, and we can tap into those kinds of talents in the industry. There are instances where sometimes clients request that we work with traditional dubbing studios, and of course we will always do that when it's appropriate. But in terms of plans for improving the margins, there are a few things that we are working on. We are investing further in R&D of our platforms to incorporate further features and capabilities that will make the process of the end-to-end process of dubbing more efficient and more scalable. And from the perspective of the kind of partnerships that we have, we will continue to identify partners in territory who can work with us very closely and can deploy our platforms within their locations, as well as with a sort of their own ecosystem of talent, in order to be able to offer those services in a much more scalable and efficient way. Phil, did you have anything to add to that?
No, I think we covered that a bit earlier on as well. So yeah, I think it's a good answer.
Okay, thanks. And then another question from Leela. I think a question about using AI for automatic translation for voiceover scripts, such as services that are provided by currently AppTech, Trados, and others. So we, right now, as I mentioned already, we do use machine learning type approaches in certain instances. We've done quite a few experiments with machine translation, and for the most part found it most kind of existing systems not to deliver the kind of benefits that we think are necessary in order for that to be generally viable. So there are certain kinds of programming where actually they're sort of quite factual, where automated translation can do a reasonable job, but the bulk of the content that we work on is entertainment, very much kind of dialogue-driven type material, so drama series and such like. And for that kind of content, machine translation, state of the art today, does not do a great job, and therefore we don't use it. We're, I think, out of time, but there is only one last question, so I think we'll take the extra couple of minutes and just answer it. It again comes from Juice, and it is: what gross margin do you aim to make in dubbing? That is, disregarding the clouded gross margins currently due to investments, as you elaborated upon. So,
I think our long-term strategy is to get the cost of sales, which is the third-party element, to be under 60% of the sales. It's significantly higher than that at the moment, and that with our own people fully utilized, that would probably bring down the gross profit to around 28 to 30%.
Thanks, Phil. So I think we're out of time. Thank you very much, everyone, for attending this session. I hope you found it helpful, and we'll see you next time. Thank you.
Is everyone?